Hey, Steve Peterson with Infinity Investments, and welcome to our channel. And on this channel, we help commercial real estate investors and agents by delivering valuable and timely content on the marketplace and on best practices. And in today's video, what we're going to be talking about is developing your investment criteria. Now, this is a topic that I think is not spoke about enough in the seminar world or in the content space in commercial investment real estate, yet it is very, very important. So I want to talk to you guys today about 4 key things that are critical to success when setting up your investment criteria. Number 1 is establishing your investment plan. Now, what I mean by that is this. Just like if you're an entrepreneur and you run a business, we have to have a business plan if we're going to operate our business successfully. But what we find is that a lot of investors, particularly real estate investors, don't have a written investment plan with their end goal in mind and the strategies and tactics in place to get there. Very, very important. A lot of times people invest in stocks or other type of investments that involve advisors will sit down with them, put a plan in place to say, hey, when I hit these milestones, this is when I can retire and ride off into the sunset, so to speak. For a lot of real estate investors, we typically just have a goal. I want to have 1,000 units of multifamily. I want to own 10 hotels. I want to own 100 houses, whatever that might be, right? But what we don't typically have is that written out plan of how we're going to get there and then what are the strategies and tactics to make it happen. Okay, so that's the first thing I think you need to do. It doesn't need to be an elaborate 20-point business plan written out in some kind of software. It could be a 1 or 2 pager where you just simply say, hey, look, in the next 20, 30, 10, whatever your end goal is in terms of years, in that period of time, I want to accomplish X, right? For me, that is having 2 times my living expenses coming to me in the form of passive income, in the form of rental income and passive income for my real estate business, my real estate brokerage business. I want to have 2 times. So my living expenses somewhere around $10,000. I want to have at least 20 grand coming in net positive cash flow. And that for me is not retirement, but that's when I can then just, do what I want to do when I want to do business wise and have the freedom to kind of live and operate. But what's your win it all? What's your end game, if you will? Everybody's going to be different. All right. You really got to take some time to figure that out, because if you don't know what that is, then it's going to be very difficult to navigate when there are challenges or when there are shifts, if you will. And they're going to be, by the way, if you haven't noticed, there's going to be some sort of challenge. There's going to be some sort of shift. You need a guiding map to navigate you through there other than, let's just do this deal, So having that plan in mind is going to then help you out also to figure out what types of properties, when you're going to buy, when you're going to sell, all these types of things. So it's very, very critical to have that mapped out. And what I'm saying to you is keep it simple. But have something with the end goal in mind, with some strategies and some milestones in place that maybe you can share with someone else. Maybe not your negative cousin that is going to knock you down, but somebody who you respect in the business, or somebody you work with, or somebody you've done some deals with, to say, hey, this is what I'm thinking. What do you think? Get some feedback. But establish your written investment plan. That's number 1. Okay. And that's a segue into the point number 2, which is selecting your required rate of return. All right. Now, this is a big one. Okay. And I'm not necessarily just talking about like cap rate. All right. The capitalization rate. That's important. But what we're talking about is your required rate of return when you buy a property, okay? That number is going to vary on a few different things. First of all, it's going to vary based on your plan. You may say, hey, I want to end up having 1,000 units in 10 years. Well, if you said I want to have 1,000 units in 30 years versus 10 years, those 2 plans are going to be a little bit different in regards to our required rate of return. Okay, so you figure out your plan. Now you kind of say, okay, in order to get there, I've got to make at least 10% cash on cash return each year or 10% cash on cash return each deal that I invest in. All right, and you might say, hey, I need to make 20 to 25% internal rate of return on each deal in order to have it make sense. Okay, so that's all going to vary depending upon on your plan and the timing of it. the key thing that I want to point out in terms of your required rate of return is what is your cost of capital, okay? What is your cost of capital? In the CCIM curriculum, right? Certified Commercial Investment Member, that's a designation you get, but it's a series of classes that you take in order to get it, or you can just take the classes to really become an expert on investments. In the CCIM curriculum, it talks a lot about cost of capital, and companies kind of look at their required rate of return as, in many ways, is that cost of capital. And that cost of capital could be a cost, it could be an opportunity cost of, hey, if I'm going to take my time, effort, and resources to go out and do a deal, I've got to bring X in, right? Or it's the actual hard dollar, cost of capital. So maybe you're investing with the line of credit, or maybe you've pulled some money out of your home. Let's just say you've got an equity line, and my equity line on that home is 4%, right? And so that hard dollar cost of capital on that equity line is 4%. Now you're going to take that money and invest it. You bet not make 3% on that investment, because guess what? Now you're losing money, right? So if you're required, or your cost of capital is 4% on your HELOC that you take out, now I would say then my required rate of return is going to be at least 7%. Why is that? I need to have a spread. That I need to make sure we make money, but also we need to cover our downside risk, right? So we don't want to be going into a deal upside down at all. All right. So that's why you need to figure out what your cost of capital is in order to really accurately define what your required rate of return is going to be. All right. And if you're investing your own cash, it might be, hey, if I took this cash and invested into the stock market, okay, what would I maybe look to make? And therefore, if I'm going to take this cash and invest in real estate, I need to make more. Or if I'm going to take this cash and invest it in, like as an entrepreneur, invest it into my business, what would I look to make there? Therefore, that kind of relates an opportunity cost. So when I take that cash and I invest it into real estate, I need to make X, all right? Or you look and say, hey, my time is valuable. Maybe I got multiple businesses, I've got multiple kids, or I'm a busy executive or whatever. And so if I'm going to take my time on the weekends to go look at properties, evaluate properties, do the things that landlords do the things that investors do, I need to make X amount on each deal. I know a lot of house flippers, for instance, that would say, look, I'm not going to touch a deal unless I can make 30 grand. I know a lot of apartment owners that are going to say, look, I'm not going to touch a deal, right, unless I can double my initial investment in 5 years. Or I know some people say, I'm not going to touch a deal unless I can make net yield 10% cash on cash every single year. Well, what's your required rate of return? Have you sat down and thought about it? I get too many clients and prospects when I'm talking to them about what they want who are vague. So as the broker, the guy who's got his feet to the street finding deals, when you tell me, I just want a good deal, and I say, what does that look like? I just want to make money. That don't help me out at all, nor does it help you out. When you sit back and say, look, I need to make 8 to 10% cash on cash return. I need to make 20 to 25% internal rate of return. I need to buy deals that are 20 units above, okay, in certain areas. Now I know exactly what you're looking for. So when I bring you deals, I'm not going to bring you crap that you don't want to look at. That's why it's very important for you to crystallize your required rate of return. That's key, okay? Very, very key. Now, the next thing we need to think about and talk about is cash flow versus appreciation, all right? Here's the deal, though. Here's the deal I want to say. You don't have to choose like one or the other, right? And in commercial real estate, we have the benefit of what's called forced appreciation. And what forced appreciation is the value increase of a property by essentially increasing the property's net operating income. Okay, so commercial properties and income properties are valued based on the net operating income that they bring, right? So if you figure out operationally how to increase your net operating income, you essentially, all things being considered though, cap rates being consistent, all things being considered, you increase the value, okay? But something similar can be done in residential in the sense of, okay, you get an ugly beat up property, you physically fix it up, you can now increase its value, okay? But in commercial, it's more so based on the net income that you bring in, okay? So everybody, when you're buying a property, you want to be looking at ways to increase the property's net operating income, all right? That should be a given. what I would like to say is I don't think you can control appreciation, okay? Because what we don't control, while you can influence the net operating income, you just don't control what happens in the marketplace, right? So you may improve your NOI, but let's say if cap rates go from, let's say 5% to 7%, you might not have that value increase. Therefore, I believe that cash flow should be the primary focus of what of what you're investing. Now, I know a lot of smart people that are going to say, I'm not so concerned about the cash flow. I want to buy in an area, increase the rents, and make money, at that point in time. And I know people who make millions and hundreds of millions of dollars that have that philosophy, okay? The thing about it is, especially if you're starting out, what you don't want to do is get into a property that has a negative cash flow, meaning that now you have to come out of your pocket to feed that property. I just think that if you stick by a rule of thumb that every property's got to have positive cash flow, and then we find ways to increase the value. You cover your downside risk, you make money while you own it, and you make money on the back end, okay? However, here's the deal. You might be making a lot of money in your job or your regular business. So your plan may be more about asset preservation and putting your capital to work and growth long time, whereas you're making a killing in your business or your job. So cash flow is not important. But if you're investing like that, what I would say to you, just make sure you cover the downside and don't put yourself in a position of negative cash flow. And the reason I say that, because I cut my teeth in the Great Recession, all right? I saw a lot of good people, good real estate investors, smart real estate investors go upside down. The value was less than a mortgage. And it is very difficult when the value is less than a mortgage and you have to pay for it every month to hang on to that property. It stops making sense to hang on to that property. So if you calculate it right and you have positive cash flow, you can eliminate that one, okay? That risk, if you will. Now, last point, point number 4, physical aspects of the property, okay? And by this I mean, do you want to buy properties that have flat roofs, pitched roofs, hip roofs, okay? Do you want to buy properties that have copper piping, okay? Do you want to have like apartment buildings? Do you want to buy garden style apartment buildings? Do you want to buy high-rise apartment buildings? Okay, we talk about neighborhood. There's different class of neighborhoods. A neighborhoods, B neighborhoods, C. A is a higher income neighborhood. B is more middle of the road. C is more lower to moderate income. D is what we call the turf, the hood, maybe a real tougher neighborhood. Okay, where by the way, you can make a lot of money in, all right, and do a lot of good by being a quality, operator of properties. Here's the deal on that. You figure that out. You figure that out. I will say one thing about the physical aspect of the property. Try to stay away, and if you're in California, stay away from properties that have brick foundations. And if you're going to buy a property that has a flat roof, all right, sometimes you can't avoid it. A lot of times people say, get away from flat roofs. Just make sure that either there's a warranty on the roof that you buy, or you budget in there for repairs, or you budget in to replace the roof, and maybe you can use that to negotiate up front. But the bottom line is you pick that. You figure out the physical, but you need to figure that out, all right? Because you want to be selective when you're going through these properties, so that you can reach your goals, so you can get to that pot of gold at the end, so you can get to that win it all at the end of at the end of the tunnel, and you can do so with fun and not being bogged down by some property that you don't like, okay? I hope this has been helpful. If it has, please like and subscribe to this channel, because we're going to continue delivering this kind of content. And I look forward to seeing you guys on the next video. And until then, have fun and continue building on your investment empire. Peace out, y'all.